I think certain parts of the market, yes, are running ahead of themselves. I mean, I think, as Karen mentioned, possibly the most interesting part of the report is the fact that not so much the food prices, although those are high, but you can argue that that's because of things going on in the world. It's really the rise in rents, which I think the ECB will look at and be a little bit worried by. What I would say is that expectations that we're going to have to start shifting from a rate hiking cycle to eventually, in the not too distant future, a rate cutting cycle are probably overly optimistic. So it's really the middle of the curve around the 3-4 year area where I think the expectations are too optimistic. It's that part which needs to go higher. And people have to get, I think, a bit more pessimistic about how interest rates are going to evolve for the next couple of years.
What about your markets? Where is there opportunity at the moment in credit?
Well, the credit markets have had a very good July, just as the US stock markets have had a very good July, in a sense that there are two reasons for that. One is the market was oversold going into the middle of June. And secondly, there's a good seasonal trend, which in a bear market, typically July tends to see a rally. However, our view is that rally is going to finish within the next week or so. We're going to head into the third leg of big selling in terms of credit markets. I would actually be buying protection at this point, taking more bearish positions on risky assets, not just on credit, but also equities, in the belief that the second half of August, September, October, they're going to be very difficult months because of the macro backdrop.
Fascinating comments, Guy. Can I just come back to the point you're making about how interest rates will evolve in coming years? Because it feels as though we're writing a new chapter at this point as we look at these jumbo-sized increases by central banks. But from your commentary, it sounds like it'll be a short chapter.
Well, I think that it's going to be a pretty violent chapter. I mean, I would argue that probably rates will have to go higher for longer than the market is anticipating at the moment, particularly in Europe, but also to some extent in the US. I mean, I think that particularly you can see some steepening in the curve between the 2 to 4 year area, because as you've mentioned with these inflation data, and we'll see with the US report, but if the US report shows the same kind of sticky rising rent figures, which are what we call the second degree inflation figures, then people are going to have to start getting used to the idea that rate hikes are going to continue for some time.
We put this all together, though, from the consumer perspective. A higher rents that they're paying, a higher mortgage cost, you've got energy prices going up more at the supermarket. Is there any option here that if rates go up, that we have a recession because consumers simply cannot weather those increases?
I think that's likely, yes. I mean, I think that the economic outlook is pretty grim, but as we learned in the early 1980s, when you have rising inflation and a weak economic outlook, you have to deal with the rising inflation first. So that's why I think the central banks are going to continue to be tough, both in the US and in Europe.
Guy, any sign of the bond vigilantes out there after this anti-fragmentation tool has been detailed to markets? Do you get a sense that we could see a run on any element of the periphery at this stage?
I think that's another possibility too. I mean, if we're in a world with high inflation and also in Europe, fairly unequal inflation, because we have some centers, those economies which import more energy rather than economies which actually produce more of their own domestic energy. And there are differences within Europe. Some economies are more vulnerable to inflation pressure. So it's not just Germany, but what people are concerned about is Italy. And yes, there's a good chance that things will, we could have in a risk sell-off, as I was saying, in September, October, we could have another bout of pressure on Italy as well.
While we're on the subject of risk aversion, Guy, any evidence that we're beginning to see any distress at all in corporate credit? We've just interviewed the CFO of ABN AMRO, and they've actually written back some of their impairment provisioning, I guess, because they feel more confident that we're not going to see a spike in problems. But what are you seeing at the moment? The markets seem to have been remarkably well behaved so far.
Well, so I think you need to differentiate a little bit between bank risk and corporate credit risk, because one of the things that's happened since 2009, corporate credit markets have got a lot more risky, and bank loan growth, particularly in Europe, has been very, very slow. So probably relative to what we would have seen, say, 20 years ago, there's more risk in corporate credit markets than there is in the bank balance sheets. But what I would say is that we had a very difficult first 6 months of the year in terms of credit spreads widening a lot. We've had a bit of a recovery. I don't think the selling pressure is finished, so I think that corporate credit spreads are going to take another leg wider.